conference, an interview you don't want to miss. As markets fall, a reminder, we are down to levels we haven't seen since November 5th of last year when Donald Trump was elected president of these United States. This is Bloomberg.
Welcome back to a special edition of Open Interest Live from Bloomberg Invest in downtown Manhattan. Let's get a look at this sell-off. We've had 13 minutes of cash trading, and it just gets uglier. The S&P 500 off by more than 1% right now, Matt Miller. That is after a 1.8% decline yesterday. You take a look at trading volume right now on the S&P 500, 60% higher than its 20-day average. So there is a lot of activity in this sell-off. You take a look at the NASDAQ 100, big tech not escaping the pain. The NASDAQ 100 down about 1% as Tesla, Nvidia take it on the chin. And then the small caps, Matt Miller, we all care about this. The Russell 2000 down about 1.8%. Actually, this is actually lower than it was pre-election, the Russell 2000. So those gains completely erased.
Just looking at your screen here for the Dow Jones Industrial Average down at 42,758. I gotta say, I'm having trouble matching my mood in these markets. I'm so excited to be down here at the Invest Conference. We're about to talk with Mark Lipschultz. Sonali's about to interview Harvey Schwartz. We have some fantastic guests throughout the day. And tomorrow as well, I want to remind everyone, Tom Wagner from Knighthead is going to join us tomorrow, which They own Singer, they own Revology. I care
a lot of fun photos that we're going to show during that.
There's a lot of fun, but this market, if you're long stocks, this is not a fun market to be long right now. I mean, we had a big drop yesterday after the window dressing we saw on Friday, and we're just falling further now. I think we're only about 10 points away from the November 5th levels on the S&P 500.
You might want to be if public equities are falling out of bed. Maybe
in private credit. Maybe. Well, let's ask. Marc Lipschultz joins us right now here at Invest from Blue Owl Capital, where he is, of course, the co-CEO. Marc, great to see you. Thanks so much for coming on set with us. Great, fantastic conference. I'm really looking forward to this. And there are a lot of sort of private equity luminaries here. You, of course, private credit luminaries, of course, you are one of those crew, one of the people who really kicked off this huge movement. How is private credit doing right now with the public markets taking a beating, with tariffs on our biggest trading partners, with the president cutting off funding to Ukrainian aid and joining together with Russia? I mean, what is private credit looking at this moment like?
So it's great to be here. When Bloomberg calls, everyone arrives. That's the place to be, and it is very exciting. As you said, I share your energy despite the difficult environment. The setup, as you just said, honestly, is pretty right on, which is the purpose of private credit is to be the durable, predictable solution in volatile times. Right? The whole purpose of everything we do at Blue Owl, all our products, private credit included, is focused on that idea of predictability, stability, more downside protection, and income orientation. And the idea of being able to build things that are durable through, and you listed a lot of variables, and there are a lot of variables in the world that are moving around. And I personally don't feel either qualified or certainly desirous of having to take such a strong position that's only going to work if you kind of call that corner shot right. So it's a very, I think, actually good moment for exactly what private markets do.
Mm-hmm. So private lenders are there, private credit ready to step in as the banks pull back. But when you do see this sort of upheaval, this uncertainty, especially when it comes to the economic outlook, I mean, what do borrowers look like? Do they pull back as well? How do those conversations sound right now?
So one of the things about private credit and kind of the proposition we have with the people we work with, we've talked about this before, the 3 Ps of private credit, which are predictability, privacy, and partnership. And let me amplify on partnership. The thing about an environment like today, as you said, is the banks, and it's not really the banks, because the banks don't lend money and haven't for a very long time to these companies, but the banks as intermediaries to syndicated markets, liquid markets. Well, those markets obviously pull back dramatically when you see something like this, logically so. And so this is actually the moment where our partner firms can lean in. Some of the strengths, the opportunities in 2022, 2023 were, hey, look, our doors were open, our capital is flowing. And so as a matter of business, we're wide open. We're very happy to provide capital to people today. And I think that's actually an opportunity for those that can access a private capital solution and not be subject to the public market on and off, kind of fickle nature.
Well, let's talk about one of those Ps, and that's privacy, because you've been vocal on the idea that private markets should be private, public markets should be public. It feels like you're increasingly alone with that opinion. We talk about this convergence of public and private. Has your view shifted there at all?
So, we all, I think, agree there's a convergence, which is to say that they're clearly adjacent to each other, and I suppose arguably anytime you bring things right next to each other, there's going to be some bleed between the two. But at the end of the day, look, I do believe that part of the strength, and I know the people that use our capital view this as a strength, is that we can take the long view, that today's red day doesn't impact our decision making. It doesn't impact, we say, oh gosh, it's a bad day, it's a bad day for volatility. We're able to look past that, not just the day, the week, the month, the years. And so I do think that, and I'm not against people innovating in the market. I love financial innovation. It's one of the great strengths of the American marketplace, and it underpins our economy. However, our proposition will remain, we partner with investors who want to make long-term decisions to make superior risk-adjusted returns, of being able to see through sometimes the fog, to be able to see through this volatility.
Right.
And I don't particularly see wanting to take that private solution and really just convert it into a new version of a syndicated market.
You mentioned financial innovation. I think you know where I'm going to go. Last week was historic in that we saw the first private credit ETF launch from one of your competitors, and it sounds like, reading between the tea leaves here, that isn't a vehicle that you would be interested in.
Look, it's not our focus, but I genuinely mean this. I'd love to see the innovation. Apollo and Mark Rowan, they're geniuses, and they're doing some really interesting things. And safe to say, I hope that it continues just to kind of push and expand the market. But no, it's not a direction we're interested in going. We are committed to being that private market solution, a reliable partner to the users of our capital, and to deliver the great risk-adjusted results we've been able to for the investors that trust us to do so.
So, and it's really private credit light, right?
Yeah, up to 35%.
It's not the full ABV of what you would get in private credit in terms of what you would expect in returns. What do you think about the solution to make some of the assets more liquid? Does that make sense to you? Does it seem like it's going to work out okay?
So we make a loan, we keep the loan. That partnership. You sign up with us, we're with you for the duration. And again, I view that as one of the reasons that great private equity firms or great corporations team with us in lending or in real estate. We do data centers for people like the Microsofts of the world, the Oracles. Why? Because we're the long-term partner. So I just don't see us migrating or wanting to. We have great liquid markets in the world today. So I think we've got that marketplace. I'm more interested in continuing to build out the private solutions. This I believe very strongly. When you have a vibrant public market and a vibrant private market, you have a better economy. You have more solutions. You have to have capital to drive the economy. And frankly, through thick and thin, what we've been able to prove with private markets is we're actually the more steady solution, right? Everything undulates, but now we have a world, and today's a perfect example. Public markets go on and off rather abruptly these days. That's very different. I started in the private markets business 30 years ago, and it was the exact inverse, right? The public market was sort of this almost always available marketplace, and private, which really was just a couple of firms. It was KKR, which I was fortunate enough to be a part of, Forsman Little, and we would come in, go out, come in, go out, and it's kind of inverted. But in either case, having both markets give us more ways to feed capital into the economy.
Hopefully you're coming in, going out.
Yes.
Let me ask you, so I get that you feel more comfortable now in private because it's a steadier state and you don't have to deal with the volatility of public markets. But you have to take a position on the economy in your business. You have to take a position especially on rates, right? And we've seen big moves down there. We've talked to Scott Bessent a couple times over the last few weeks, and he states that's their goal, right? They want to lower rates on the longer end. How do you see that playing out this year? We've already seen a big move from 480 to 410 essentially over the last month. So does that continue?
Well,
what's driving that? And what's driving that, Mark?
Well, the heart of our business, very importantly, taking a view, and we have a view on the economy, which I'm happy to share, but actually by design, we don't take a view on interest rates. What we do in the credit business is floating rate senior debt. So actually our role in a portfolio in the economy, the marketplace, is actually to provide the solution where you don't have to take that view. Because one can see the forces at work here that would make it hard to predict. And listen, Secretary Bessent is incredible and has an incredible view of this. That all said, there's a lot of variables. So we have inflationary pressures on the one hand, we have trade reordering on the other hand, we have an economy that we have to factor in, and all that taken together will determine the course of rates. I don't know the answer to that, and I feel very fortunate, but by design, that I don't have to take that view. I can provide a product that allows people to work through that either way.
Fair point, but you say you're happy to share your view on the economy.
Yeah.
And we're looking at what a lot of people are saying is a growth scare here. What is your view on the economy?
Right now, looking bottoms up, and we're bottoms up people. We're not macro strategists. We have 400 companies in our portfolio, and looking at those companies, they're performing well. On average, our portfolio grew at high single digits, revenue and earnings. Now, again, we have a portfolio that's obviously selected toward what we think are really superior businesses, of course, but that is strong. The economy, from where we sit, continues to look very, very strong here in the U.S. And I should say, we're a very U.S.-focused investment.
Right.
Our dollars deployed mostly in the U.S., again, by design. We're about risk management. This is a good place to invest.
Yeah, and it's nice to hear your conviction on the economy because you're seeing something totally different in the public markets right now. Let me just point out the S&P 500 now down more than 1%, and as such, it has officially erased its election gain. So it's wiped out all the value that it's made since November 5th, about $3.5 trillion worth. So definitely the sell-off deepening right now. Mark, we only have time for one more question, and before we let you go, I want you to talk a little bit about the competitive landscape. Of course, private credit is the topic of the moment. Competition is fierce, and you see the banks also getting in as well with direct lending ventures of their own. How do you differentiate what Blue Owl can offer?
At the end of the day, and I think it's been part of this conversation, we know our business. We stick to our knitting. Our DNA is about downside protection and about being a long-term partner to the users of our capital. And I think that's an important point of distinction. We have a lot of partners that trust us, and I think at the end of the day, that matters, because we are asking people to pay a premium. We're asking them to pay a premium for a partnership they can count on. And we've been in the business where there's a few really large participants. Fortunately, we're one of them, and that allows us to provide solutions of all types. But also, look, we want to skate to where the puck is going. Asset-backed lending, hyperscale data centers. There's reasons we're positioned with leading capabilities in those markets, because that's where we see the opportunities evolving next.
Very cool, and you're obviously doing a great job of that, Mark. We really appreciate you joining us. Thank you so much, and I hope you have a great conference. Mark Lipschultz there, who is a co-CEO at Blue Owl Capital. Of course, we are here at the Bloomberg Invest Conference in downtown Manhattan. Shanali is getting ready to talk with Harvey Schwartz of Carlyle, as well as Don Fitzpatrick from the Soros Fund. Eric Schatzker is going to join the panel as well for that, and then we'll talk to Ben Wren of SigTech to talk about AI's capabilities in finance. This is Bloomberg. We are 30 minutes into the trading day. Welcome back to Open Interest. We are live from Bloomberg Invest, a conference here in downtown Manhattan. I'm Matt Miller.
And I'm Katie Greifeld. We're gathered here in the heart of New York's financial district with executives, deal makers, and investors from across the globe. Sonali is set to speak with Carlyle CEO Harvey Schwartz in just a few moments, and I'm really looking forward to that conversation. But before we get there, let's talk about these markets, because quite a moment underway. The S&P 500 now at session lows, now down 1.5%. The banks in particular, the KBW Bank Index falling 5%. That's the biggest intraday drop in about 7 months, Matt Miller. We have erased that November 5th gain that we saw on election day. We're erasing over $3 trillion in value from the S&P 500. You can see that the NASDAQ 100 on its way there as well, down about 1.4% at the moment. Bonds are the story. The 10-year yield now down about 2 basis points. We're taking a look at 410 on that 10-year Treasury yield. We were looking at 480 just about a month and a half ago.
Yeah, it's pretty incredible. Of course, the reasons behind these moves are clear. The Trump administration has gone ahead with 25% tariffs against our 2 biggest trading partners and neighbors here in North America. So Canada and Mexico face tariffs of 25%. They will retaliate. We know that Canada is retaliating in steps, starting with $107 billion worth of goods. Mexico is going to wait, I believe, until Sunday. Claudia Sheinbaum said she's going to talk with Donald Trump on Thursday, so really taking their time with that. We also have added 10% tariffs on China, so now 20% on China. All of the goods that we buy in this country are now tariffed at more than 10%. So tariff levels higher than we've seen since the 1970s, and we haven't seen this kind of tariff raise since the 1930s. Really historic, and that is what is driving equity indexes down and driving investors to seek safety in government bonds.
Yeah, and they're certainly finding that. It's interesting. You think about this America first trade, this America exceptionalism that we've seen in the markets, totally reversing right now. I think it's really telling that you take a look since election day, you have the S&P 500 now down since then, but bonds have been the big outperformer. You think about what the consensus was, it was that you'd see stock markets rally. We're going to get all these tax cuts that you keep talking about, and that was going to hurt the bond market. We were going to see yields march higher. Turns out the opposite has been true.
Yeah, and I also think we're not quite sure about whether we're going to get these tax cuts. It does look like the Trump administration has been able to push everything through so far. I don't think anyone would have expected Pete Hegseth to actually get confirmed as Defense Secretary of the United States of America.
Yeah.
Nor do I think anyone would have expected RFK Jr. to be confirmed as the Secretary of Health. But he was able to push it through. Republican senators, even those who had reservations, to say the very least about these people, did Trump's bidding. And maybe they'll do that with the TCJA as well, but maybe they won't. In order to give Trump $4.5 trillion of tax cuts over the next 10 years, they've got to find $2 trillion of budget cuts. And that's going to be difficult for a United States Congress that really likes its pork.
Well, theoretically, Elon Musk and the Doge team are working on that. I think it's a great point that you've been talking about, though.
They've cut millions in costs.
This sequencing, the Trump administration, obviously, trade policies are the priority, not those tax cuts, those market-friendly policies that certainly was behind the big bid up that we saw since Election Day. And now we're sitting, of course, with some really big questions. It seems like markets were reluctant to believe that he would go through with these tariffs, but we certainly saw that last night.
Yeah, absolutely. I was listening on Balance of Power last night to Joe Livornia, who, of course, advised Trump in the first in his first go-round, Trump 1.0, as you could call it, and he was saying, there are a lot of people out there who think they're going to come to a deal at midnight and you're going to see this market rally 1,000 points into Wednesday. That hasn't happened. There are still a lot of people saying we don't think these tariffs are going to stick very long. It could take a little bit. It could take a little bit of negotiation, and then they'll go away, or at least they'll be whittled down. But right now, I think the market is facing the cold, hard truth that it is causing the cost and chaos that Jim Farley, the CEO of Ford, has highlighted. And you're going to see these automakers among the hardest hit.
Yeah, and another point that Jim Farley made was that it's about the duration of tariffs. I mean, these are something that stick for a couple weeks. it's a different conversation than if these tariffs are on for months and months, to the tune of several $1 billion for the automakers. We were talking to Gina Martin-Adams about where the safety is in these markets. She mentioned international stocks, and we know that Europe in particular has been a bright spot. But at least on today, you're seeing selling across the board. You take a look at the Stoxx 600 right now, it's also at session lows. It's down about 2%.
Which is fascinating because the EU has just pushed through about 800 billion euros in, let's say, spending allowances, right, on infrastructure and defense as the U.S., at least for now, abandons Ukraine in its fight for independence. I guess they don't want it to fight. They want it to roll over to Russia, and right now that's not what's happening. Let's get over to our panel. Sonali Basak is standing by with the CEO, or speaking with the CEO of Carlyle, Harvey Schwartz. Sonali?
Not only are you running one of the most storied private capital firms on the planet, you were also at Goldman, where you navigated very tough moments from the C-suite, including in the wake of the 2008 financial crisis. So you've seen a lot in markets, a lot of ups and downs.
Yeah.
How do you look at the environment that we're in today?
Well, again, it's great to be here. Congratulations on what's going to be an extraordinary event. I think it's my birthday next week. I'll turn 61. I think in my lifetime, the trends geopolitically have been extraordinarily favorable. And I think that certainly some horrific things have happened. But if you think about the Berlin Wall, globalization, and I would say that this is the first time we're really entering a period of what I'll call geopolitical economic tension. And so let's just pause on that for a second. Coming into the election, there was a lot of uncertainty. I mean, it seems like a long time ago now, but if you think back to the fall, there was uncertainty about whether or not we would have an outcome certainty around who the new administration would be. The administration ran on a policy very pro-business, pro-growth, all the factors that support that. And so markets reflected that. And I think there was this huge relief factor in knowing that there was certainty in the administration. It was a sweeping victory, consolidated government, and an ability to execute. Now, tariffs were always in the discussion. What's happened now is, and the markets are obviously reacting to it in a fairly material way, is we're starting to see what is the full policy mandate going to look like? And the reason I started with geopolitical economic uncertainty, and obviously we've had geopolitical uncertainty with the tragic war in the Middle East and the tragic war in Europe, but the geopolitical economic uncertainty, it's a new information set. And the opinions on tariffs vary from they're incredibly inflationary to they are potentially contributing to a recession. And so it's a bit of now uncertainty. And what the election originally people grasped to was certainty. Markets like certainty. And so now we're in a period of uncertainty, and I think you're seeing it in the risk reduction that we've seen over the past several days, and obviously this morning also.
When you look at what's happening with the tariff strategy, I'm guessing this kind of comes into part of that geopolitical uncertainty. At what point are you worried about it crossing over into a tariff war? Is this all kind of par for the course what we're seeing right now, or is there a risk of serious escalation?
Okay, so tariffs are a complicated subject that doesn't really get unpacked very often, so let's just try and do it super fast, given the time constraints. But if you think of tariffs, let's just split the conversation into two things really simply. One would be, let's just say, economic policy incentive tariffs, which can make a lot of sense. We have the lowest tariffs in the world relative to other countries. And then you have tariffs that are motivated by, let's say, political objectives, social objectives. So first of all, you have to unpack the two. This bucket, I think, can be reversed much more quickly. We've seen that in discussions and negotiations. This might be stickier depending on what's happening. But in terms of, and you asked, your language was perfect, Sonali, because the real question is, are they inflationary? And a one-time tariff, let's just say 25% on a country, a one-time tariff is a one-time step up in price acceleration. But it's not sustainably inflationary. Trade wars are sustainably inflationary because then, of course, you could perceive a 25% step, 10, 10, 10. And I think that's what the market is now responding to. But what the market's really responding to is increased uncertainty. Because because we just don't know where the tariff discussions are going to go. It's too early.
To the point you're making on uncertainty and the earliness of the conversation, how do you think about this as it pertains to your business? Do you have to make changes? Are there portfolio companies that are structuring differently? Are there deals that you can't do right now because you don't know what the tariff impact is going to be?
So the vast majority, so for those of you not as explicitly familiar with Carlyle, we're $440 billion of assets. We're one of the largest private capital managers in the world. That's split across real estate, private equity, credit insurance, which is our largest segment, and our solutions, secondaries, and co-invest business. We're micro-investors. So as micro-investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. So we don't, when we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. And so, yes, now in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, we have, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself, but in our portfolio companies, we roll up this data every month. For example, in the PMI yesterday, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
So what are the things that you see now that investors are going to see 4 months later?
So today, nothing about today looks dramatically different than 3 months ago. By that, what do I mean? EBITDA growth is quite solid. Earnings are quite solid. The factors around input pricing, there's still marginal pricing capacity. And demand seems quite high. The consumer seems quite resilient. I think the administration inherited quite a stable economy. You know, inflation obviously not exactly where the Federal Reserve would like it, but it's come down dramatically. And so the environment feels quite good. Now, in terms of what we're seeing in that data, there's nothing suggesting today that the economic underpinnings of that have shifted dramatically at all. What you're starting to see, though, are the things I just described, which is preemptive actions around how best to position, again, around the uncertainty. The way I would describe it is for a long period of time, you know, geopolitical economic risk tails were very tight. They're just fatter today, and we'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean. But this uncertainty factor obviously is affecting markets.
You started to hit on this a few minutes ago about inflation and worries about the impacts that tariffs would have on inflation, one time, more persistent. Where do you see the direction of travel? More recent economic data has created some cause for concern among investors.
Yeah, so first of all, we just came through an unprecedented period. And I got to give, and I know the debate around the Federal Reserve happens a lot. It always surprises me because I think the Federal Reserve and Jay Powell have done an extraordinary job navigating a massive spike in inflation. We went through an unprecedented period of rate hikes. There was a big audience calling for rates back to zero. I have no idea why anybody would want rates back to zero. Rates back to zero is not a normal way to run an economy, and we certainly shouldn't be wishing for that. In terms of getting inflation down, that's a very, very difficult thing to do. And I think the Fed has done an extraordinary job. I think at this point, given we don't exactly know how the tariffs will ultimately settle, I think the inflationary question is a bit uncertain. So what I mean by that is there is a path where you could see a one-time bump in prices, assuming there's no trade war and no future escalation, that will translate through the system as higher prices. It may also cause some demand destruction, which longer term would be deflationary. And you actually could see the economy experiencing stress as it goes through that. So I would say that all the parameters around forecasting inflation, forecasting interest rates, I said, again, I just think we should all buckle up a bit because markets will be more volatile, super data centric, probably too data centric because you can't extrapolate one data point to the future, but it's going to be a sort of a wait and see. I do think the administration will be very sensitive to pro-growth policies. And so I think they'll be watching also.
So with that push-pull going on, what you're looking at is a market that has changed so drastically in terms of rate cut expectations. You had a number of investors feeling like maybe you might get a rate hike this year coming into this year, but market consensus, now you have shifted from maybe 1 rate cut to 3. Market pricing overnight went to 3 rate cuts this year.
Yeah.
Does that make sense to you? So
we were never in the camp. You and I had this discussion 2 years ago. We've never been in the camp that the Federal Reserve was going to cut rates aggressively. Our strategic economist has really nailed this. Jason Thomas, if you don't read his work, you really should. I've worked with some extraordinary people in my career, a real privilege, and he's extraordinary. But he has the benefit of rolling up all our data. So he's been saying for a long time rates were stickier. I just spoke to him before I got on the show, and he said, listen, it's more complicated now to have a very firm opinion. Again, period of uncertainty. But it's not surprising to me that the market has shifted to this because of the unknown around tariffs. And I think what the Federal Reserve has proven to us is they're very data-centric because they know they're in a situation that is somewhat novel. So they're going to be very data-centric. They're going to do what they need to do. So if you see inflationary pressure, they're going to moderate up. If you see deflationary pressure or a slowing of the economy, I think the Federal Reserve, one thing they've proven to us now for a very long time, they know how to cut rates, and they're going to cut rates if they need to. But it's not surprising me that the market is forecasting more of that. But also, we were sort of shocked when they were forecasting 5-6 cuts, and we were calling for 1 or 2.
So I want to back out for a moment because coming into this year, there was a lot of investors saying America first. And you saw the broader market really reflect that trade. That has changed. You have seen a lot of money flow into international markets. Carlyle is a global investor. Is American exceptionalism at risk?
I wouldn't bet against America. You know, if you go back to the 90s when in the mid-90s, the European Union and the United States had the same GDP. Here we are 25, 30 years later, we have $10 trillion more of a GDP. There's a lot of fundamental reasons for why that occurred. We don't need to go through them. I think that as a global firm, we see opportunities in lots of places. So we have taken in the past several months 3 companies public. Standard Aero in the United States. We just 2 weeks ago took Hexaware public in India. It's the largest private equity-owned company to ever go public in India. We took a company called Rigaku, which is an X-ray technical company in Japan public. It's the largest ever private-owned equity company in Japan. All of this in the past 6 months. And our portfolios have gone up $5 billion in value, and we've returned a lot of value to clients. I would say that, is it surprising that after the S&P was up 50% plus in 2 years, and the rest of the world had lagged, that there's been more capital moving overseas? No, I do think that if you're going to have a European Union that's going to be very focused on, for example, defense, which is not a surprise to us. We've had an aerospace defense practice for a very long time. On the heels of all the global conflict, defense is going to be a sector that's going to grow secularly again for a very long period of time. Regardless of tariffs, it doesn't matter. And so in a period where you go from geopolitical and globalization to less globalization, you're going to have increased spending on defense. So you're going to see defense stocks go up in the U.S. I think it all seems quite rational to me. But no, I wouldn't bet against America.
So I want to shift gears a bit now, because there is this dynamic going on in the markets where you have, of course, the public markets, and then you have the private markets, which, of course, you operate well, and you've kind of operated many times through both throughout your career. So in the mid-1990s, there were more than 7,000 companies. Now there are less than half of that. Many people talk about that being the dynamic of the situation we're in. Nobody talks about what the implications are. If you have such a vast private market, what do you do with that? How do you get more investors access to that?
So you nailed it. I mean, if you went back 20 plus years, there were twice as many public companies. I think there were 8 times as many public companies. If you went back even farther, now there's 2.5 times as many private companies. And the private capital formation has been a trend that has been incredibly persistent for lots of very meaningful reasons. And it's secular, it's not going to change. Any prediction in terms of the sustainability and durability of private capital suggests it's going to keep compounding at 10%. So it'll be a, $25, $26 trillion market before we blink in terms of private capital. Now, what's happening is there are a lot of forces in the system that are driving more capital to private markets, demand from insurance clients as they look for private investment grade. And of course, the biggest factor is, and a lot of you are involved in this business, is what's happening in wealth. And really, if you look at whether it's 1%, 2%, 3% of portfolios in wealth individuals' portfolios today managed by people in this room, then if that grows to 5%, 6%, 7%, we're talking about an enormous trend. And I think the stats on U.S. pensions, for example, 40% are in alternatives. Ultimately, retirement accounts will be in private capital. It's the perfect balance of liability and return, and it gives investors diversification. So
401ks?
Ultimately, yes, for sure. Pace of which, hard to predict. But the wealth transition to private capital, for sure, is a durable transition. Should be. The asset class makes a lot of sense for a lot of people. Advisors, I've spent a lot of time with advisors in the past 2 years. So Carlyle has been in that part of the business for a long time, but it wasn't strategically important as an initiative. When I showed up, we switched all that. We reorganized the team. It's one of our fastest growing areas. But this is, again, we've scratched the surface globally on wealthy individuals participating in these markets. So that capital stream will continue to come in.
How do you think about what might need to change about the industry in order to make this more available to wealth clients as opposed to institutional clients who have been able to get into a private fund, hold it for a very, very long time? Now you have investors borrowing their 401k that might want more liquidity. And do you think that that presents another set of risks too, a mismatch perhaps?
So I think the only thing that gets in the way of the industry and the growth of this is the industry. So if we execute at Carlyle, we don't want to rush. This is all about performance. If we say we're going to do it, we have to do it. And we have to understand the ultimate wealth client who's managed by an advisor or an RIA or one of the big platform partners that we work with. That is our obligation. And as long as we deliver the performance consistently over a period of time, with all the risk factors understood, then we will be successful and the industry will be successful. The only thing that worries me sometimes is there's a bit of an arms race, it seems, to develop solutions. There's clearly competition on the advisor side. Carlyle, I'm super fortunate that I had the opportunity 2 years ago. It's a really iconic name in finance. It's been around for, well over 35 years. To be successful in this industry, particularly this segment, you need global brand recognition. Carlyle's well known. We have wealth partnerships in the Middle East, in Korea, in Japan. We tend to think in a very U.S.-centric way that the wealth phenomenon is a U.S.-centric phenomenon. It's a global phenomenon. And that's why I feel confident in saying over the next 5-10 years, you'll see this trajectory of growth.
So we talk about private markets like it's a monolith. But of course, it's private equity and private debt and infrastructure and real estate and all of the above. Private credit in particular has gotten a lot of focus, that $1.6 trillion market of direct lending. It seems that the industry is pushing away from just that into new places. What's the biggest growth area in your mind, and what is driving it? Are there mega forces that will make this industry much bigger?
So I don't... So there's a flywheel effect in capital formation. This exists in public markets. I mean, if we went back many, many years ago, ETFs were new, then they became very efficient tools, then they became some of the most popular tools that exist in the marketplace for investors for a lot of obvious and very rational reasons. It's very hard for finance professionals to create demand for a particular form of capital. I don't think we're actually particularly good at that as an industry. When we really operate well in finance, and having seen it at over 30 plus years, when we really operate well is when we truly understand the client demand for capital. And what is the client demand for capital? The businesses that get supported by this capital are just looking for the most efficient form of capital. So they're not being sold direct lending. They're choosing direct lending over other sources. But what has happened, direct lending in many regards, which has been around for a long time and really grew quite quickly over the past, call it 5 years, what's really happening, though, is the understanding of the capital choices continues to expand. So direct lending will continue to grow, although more mature today, but now asset-based finance. And there are forces in asset-based finance, private investment grade, returns, and really at the end of the day, what allows us to be most effective at that, Sonali, is we have the right liability structure. So because we have longer liabilities, which our clients provide us, whether they're wealth clients, institutions all around the world, we're able to structure and deploy that capital. But again, it has to be the most efficient marginal capital for the end user. There's no creating something and people come. These are really thoughtful business owners that are choosing to use that capital because it's the most efficient capital. And that's what we have to provide.
Harvey, we are out of time. You spared yourself from my lightning round. Really? What are you doing for dinner for your birthday? You can have that.
I'm hosting the first partner offsite Carlyle's had in a long time. They asked me if I would do it on my birthday, so I said, so all of our partners are going to an offsite for 2 days. I'm super excited about my birthday.
That sounds like a blast. Thank
everybody,
you so very much.
I hope you found that helpful. Thanks so much. Have a great conference.
And that was Carlyle CEO Harvey Schwartz speaking with Sonali Basak. And as they were speaking, you saw session lows in the S&P 500. We were down as much as 2%, Matt Miller, pairing slightly down about 1.8% right now. That is a little bit worse than the NASDAQ 100, off by about 1.7%. Breath, pretty awful. You take a look at the sector level right now, just one sector in the green, and that is consumer staples. A lot of that coming from Walgreens, a lot of deal speculation there. I do want to focus in on the bond market, though. You saw the 2-year Treasury yield down about 8 basis points. Traders now pricing in 3 rate cuts for the entirety of 2025. There is about a 50% chance that we could see a rate cut in May, a totally different picture than where we were just a few weeks ago when it comes to the Fed's expected path forward here. Yeah, absolutely. I mean, if you look at, first of all, the equity indexes right now, 57.47. We're well under the levels now that we closed on November 5th. So well under where we were when we elected Donald Trump to office. And at the top of this show, remember, we were still 1.6% above that. So that's one thing. The other thing that I think is interesting is that we're pricing in all of these rate cuts, now pricing in more than 50% chance of a rate cut in May. Yeah. At the same time as inflation is headed higher. I was talking with our chart producer, Dan Curtis. I've heard of him. Before this show came on. He made a fantastic chart, 2, 6, 7, 8, that I think they have loaded up in the control room. And you can see the 2-year break even just headed higher as the 2-year rate continues to head lower. So that divergence, I think, is really fascinating. Yeah. Joe, have you got the chart? Joe, you have the chart. Joe, pull up the chart. Joe's going to pull up the chart. 2, 6, 7, 8 is the number there. You can see it. Real cause for concern, because if the Fed is forced to cut rates to save the economy at the same time as inflation is re-accelerating, that's not a great position for consumers. That's when you go into what we call stagflation. Yeah. It is no bueno. I definitely do not envy the job ahead for our monetary policy makers. A really difficult needle to thread there between inflation fears and growth worries right now. We'll continue to follow these markets, but also happening right now, we have TCW's Katie Koch, Diameter's Jonathan Lewison, and Mark Lipschultz from Blue Owl speaking with Bloomberg's Danny Berger. Let's go there now. More options. And so for us, just to conclude, one of the things that we're always trying to do for our clients is be relevant to the borrower. Because if we can be relevant to the borrower across all of those choices, we have more alpha opportunities to capture on behalf of our clients. So we do see this convergence deepening, and we see allocations going up pretty dramatically, in our view, over the next decade. There'll be some vehicles dedicated to those segments, and there are also going to be some vehicles, both for institutions and wealth, that capture both segments. So you're talking about some of the borrower driving this. John, I'd love to get your point of view, because you have both public and private credit too, about what is causing a blurring of the lines.
Well, look, I think that borrowers are commercial, and they're reacting to incentives. Historically, where private credit came from was the middle market not being served by the bank syndicated loan market.
By the way, you can watch more of this Bloomberg Invest conference. If you've got a terminal in front of you, just type LIVE Go, Live Go, to watch more of this panel. Mark Lipschultz, Jonathan Lewis, and Katie Koch, very fantastic group of guests coming up as well. And we're going to hear from some of my favorite people here at Bloomberg. Eric Schatzker is going to be up on that
I know
stage.
You love him, and he loves you too.
I'm looking forward to it. Right now, I want to talk with Bin Ren. He is SigTech, the founder of SigTech and the CEO. That company coming out of Brevan Howard when he was working there. It creates AI co-pilots for investors, and I find this so fascinating, so I'm excited to get into it. Bin joins us here on set at the Bloomberg Invest conference. Bin, explain to us, if you could, the elevator pitch of what you're doing. I imagine these little AI agents that are better analysts and better investors than we are. Is that what you're looking to do?
I think at SigTech, we are building a team of specialist AI agents that collaborate to automate previously unautomated, very high-value processes.
Well, by the way, what do you mean a team to collaborate? Does that mean you have multiple large language models that work together? Or, I mean, don't you just have one AI? How's it a team collaborating?
Yes, so the first we have to talk about what's an agent and why that's different from a large language model. An agent is powered by a large language model, like a brain. But then the agent has to be able to access private data, use tools, and then pursue a particular objective almost entirely autonomously. So it's a big step up from a chatbot. So when we say we build a team of AI agents, we literally build an army of them, each one specializing in something very specific. For example, we have dedicated AI agents trained to analyze central banks. Everything coming out of Fed, Bank of England, Bank of Japan, the analysts can actually read the raw materials, sometimes in a foreign language, and analyze the nuances and give us very good answers in English. And then when a user works with this team of AI agents, you are essentially working like a supervisor with the team. That's really transformed the way we think about work and how we approach our daily workflows.
That's really interesting. So is the goal here to replace human analysts? Is that the end state that you're trying to get to?
I think we can't. No, the end goal is not to replace human analysts because we all want to do intellectual and creative work. The agents can do today is to automate intellectual but non-creative work, and there are plenty of them. For example, generating graphs, reports on a periodic basis, but that cannot be previously codified and automated. Now today we can. For example, our clients use our AI agents to do commercial loan underwriting, which previously took hours, now takes 30 seconds. It makes a big difference.
And so I want to go back to your origin story a little bit. I mean, Matt mentioned that you were part of Brevan Howard. You spun out in 2019, and the conversation around AI in 2019, I'll be honest, I don't even know what it sounded like. For a lot of us, we started talking about AI every single day with the launch of ChatGPT, I think in 2022. So just reflect a little bit. I mean, how has your business and those conversations that you're having changed since 2019, which feels like a lifetime ago?
That's right. In 2019, we started the company without a particular emphasis in AI. So we were building all the infrastructure and tools to power human analysts. Data analysts who have to use programming language to build portfolios, do risk analysis. So the first 3 years of our company's history, we were building tools for humans. And then 3 years ago, we made a very big bet on generative AI because the moment I realized we can spend the same amount of efforts on training large language models to do some of the jobs, we're starting to put a lot of efforts into that area. And today, we are entirely AI focused. Everything runs on the same infrastructure we built over the years, except now, essentially, we are building tools and infrastructure for AI agents who can be hired and used by humans instead of building tools and infrastructure for humans directly.
All right, so I have so many questions.
Yeah, I can feel you vibrating next.
No, because it's so fascinating to me, but just to get the basics down, does that mean at Brevan Howard you had trained your own large language model? Or at SigTech, do you train your own large language model? Or do you use the models from other hyperscalers that have already spent the billions of dollars necessary to do that?
We use different models from different vendors, from OpenAI, from Anthropic, from Gemini, from Google Gemini. Up until, I would say, 4 months ago, OpenAI models had such a big lead on their competitors. So they are definitely the most popular large language model that we use. But very recently, we can see this quality in Anthropic models, in Google Gemini, have go to the point where we are building agents that are powered by those large language models for very specific jobs. They actually do a better job than OpenAI models. And we also have access to DeepSeek, hosted in the US. So our business is about building the best agents, the best team, each one powered by the right large language model for that job. So it's all about specialization.
So now a couple of asides, right? Just to note, you probably knew that Sam Bankman-Fried's Anthropic investment was going to be a runaway hit before we did, right? And then also, DeepSeek. What's your take on that? Is it really something that they could create on the cheap, or do you think they actually spent a lot of money to do it?
At DeepSeek in the last week, I actually spent the whole week open source a lot of their own infrastructure. So I think one of the major breakthroughs by the firm is about the increase of efficiency in the efficiency of training. You see the way the large language models are trained, if I will get a bit of technical details, is that it's in training parallel. So you copy the copied neural networks, many copies, scatter it around the large cluster of GPUs, and then you split your training data sets into different piles, essentially. So you can train multiple copies of the same neural network using different piles of data. But then you aggregate the learning, because it's based on gradient descent. We actually aggregate all the learning together, update all the models, and do it again. So there's this up and down usage of GPUs. When they are learning, all the GPUs are at 100%. But when you aggregate the learning, the GPU are actually underutilized. So DeepSeek essentially figured out a way to always keep the GPU utilization as high as possible. So it's cheaper, it's faster. So efficiency gain by DeepSeek is open sourced. Now everybody is going to utilize it.
Yeah.
So that's going to help push the efficiency frontier of large language models forward. So everybody benefits.
Yeah, that's a really interesting take, that obviously this isn't something to be ignored, what DeepSeek did. It feels like some investors were eager to just kind of filter it out. I do want to take a step back and talk about how AI can potentially fit in to the financial world, to the investment world as well, because the question that I always has is whether AI will be more helpful when it comes to productivity, or whether we're going to be actually generating investment alpha using AI when it comes to investments. It seems like your business is more about increasing productivity rather than generating alpha necessarily.
Yeah, I agree. So I think human will always stay in the loop for the foreseeable future, because the world's regulation, the framework is a human-centric. Right? The regulators want to be able to point finger to a person who is accountable for all the actions and decisions. So I think for the foreseeable future in financial services, it's all about how to turn one person into a super performer, backed by a team of AI agents. I think the nature of our job is changing from being an individual contributor to everybody will be a team leader. Everybody will be a team leader, a supervisor, an orchestrator, and that's how we dramatically improve the productivities.
And I hear what you're saying, that you see everyone becoming a team leader in that model, and that
everyone gets a medal.
Everyone gets a medal. Everyone is a boss. You're not trying to replace human analysts, but if we do see these big productivity gains, is it reasonable to think that people will lose their jobs as AI starts to really become more integrated in the financial world?
I think people will find new things to focus on. I think people will find more time and energy to focus on more creative, focus on people, interpersonal relationships, meeting customers, understand their needs and wants. Right? Maybe the translation from their preferences and needs and wants into investment portfolios is highly automated, but understanding that what they truly prefer, it still requires a human touch. I think the emphasis in our job will shift.
I hope you're right. And I hope the Bobs understand. I'm a people person.
You certainly are.
I'm a people person. I was looking at your slides. You put on a presentation before, and noticed one of them is similar to something that Mark Lipschultz was telling us earlier as well about public markets, that for a long time they were fairly stable, and now they've become very volatile. You say capital markets are becoming less efficient, and I think that's kind of the same thing, right? Why do you see capital markets losing their efficiency?
I would argue that the public market, if you think about it, there are a few things going on in the last 15 years. Number one is the tens of trillions of capital going into passive investment funds. By definition, the passive investment fund doesn't contribute to price discovery. On the other hand, if you look at the largest stocks, in the last 10 years, it just so happened that the biggest stocks are quite often the best returns in any given year. And today, the top 26 stocks in S&P 500 are together accountable for half of the market cap. I have never met a person who can name the other 474.
There's a lot of them, to be fair.
So you see that the issue is that active equity management has really had a very bad run in the last 15 years. And we can see that in the numbers. The number of equity analysts has gone down by over a third in the last 10 years. Because, the truth is that the efforts required to analyze a $1 trillion company is not 1,000 times more than the efforts required to analyze a $1 billion company. It's roughly in the same magnitude. So why would people spend their energy on the other 474 when they can deploy the same amount of capital if they just analyze the top 26? I think that's the fundamental issue in the public market today. There is this gap between the number of companies looking for coverage and analytical analysis versus the amount of power we can provide to cover them. The only way to bridge the gap is to use something like generative AI and AI agents.
All right, Ben, we got to leave it there. So great to get some time with you. A really fascinating conversation. Looking forward to keeping in touch. That is Bin Ren of SigTech. Meanwhile, we do have some breaking news here. We're hearing from Ukrainian President Zelensky saying that the first stages could be a prisoner release, a truce in the sky. Interesting here when you think about the tension, the heated exchange that we saw in the Oval Office last week.
Absolutely. I think the most important point is that he's ready to work fast to end the war. He's ready to work quickly to end the war, I think is what he means there. And that's a direct answer to Donald Trump's plea for peace. So he does say he's ready to take those steps if Russia does the same. And we know that this administration has a very close relationship with the Russian administration and Vladimir Putin. So maybe they'll be able to work that out. Zelensky's saying that the way that he regrets the way that the White House meeting turned out, or that it was regrettable.
Right.
I'm not sure if this is going to be seen as a full apology, but that's something that, of course, the Trump administration is going to want to see. They want an apology, and they want, a sure aim that he is ready to make peace.
Yes.
Now, the question is, does that mean giving up ceding all of the lands that the Russians have taken in this war?
Yeah, and these do echo his comments that, of course, he would be willing to come back to the U.S. if that offer was extended, if we're talking about serious talks here. So a lot of words. I'm not sure, again, to your point, the Trump administration wants an apology here, and it doesn't seem like these comments get all the way there. But
keep in mind, the Trump administration has cut off aid to Ukraine. So the U.S. is no longer going to be financing, at least for now, the independence of this country against the Russian aggressor.
Right. Let's take a look at these markets right now, because these comments come against a very volatile backdrop. You take a look at the S&P 500. We're off session lows that were 2% at one point, but now down about 1.6%. We know that we are just about at the November 5th level, or just below it right now. That sell-off certainly has been deepening throughout the course of the morning. You take a look at the NASDAQ 100, off by about 1.4% as well. Big tech is not escaping, and Gina Martin Adams of Bloomberg Intelligence making the really interesting point that tech is going to be hit hard by some of these tariffs that we're talking about, that their cost of goods sold, the majority of it comes from outside the U.S., so clearly big tech would be right in the crosshairs there. You take a look at the bond market as well. You're looking at the 10-year yield, which is down about 1 basis point. I want to zero in on the 2-year yield. You think about where those Fed cut bets are being priced in. It's to the short end of the yield curve. The 2-year yield, I'm sure we'll show it in a second. We are well below 4% there as traders price in 3 rate cuts in 2025.
Yeah, I mean, we were showing that. That was my terminal. What was it? 2678.
I don't memorize the terminals in the
was the chart that we were showing
with the break-even,
the 2-year break-even rate, and then the 2-year Treasury. I think the headlines we're getting across also right now from Canada are pretty fascinating, or at least from the Wall Street Journal, which is saying that Ontario is going to issue 25% export tax on electricity to the U.S. And we do export a lot of it. Oh, here's your chart, Mike.
There we go.
Thank you very much, Joe.
All right, we got
you
there.
can see there in blue the U.S. 2-year yield. It is now down below 4%. That's on the left-hand side of the screen, and then on the right-hand side of the screen, you can see that the break-evens are headed higher, which means inflation is ramping up.
Yeah.
I wanted to get to this Ontario tax because, okay, according to the Wall Street Journal, Ontario is going to issue a 25% export tax on electricity. We were talking about export taxes in our meeting
at 6 in the morning
this morning. Electricity is one of the key resources, if not the key resource, that Canada exports to the U.S. We take a lot of energy, we take a lot of natural gas, we take a lot of oil, and a lot of electricity from Canada. Also, the aluminum that we buy from Canada, the reason that we buy it from them is because they have much cheaper electricity than we do, and aluminum is essentially electricity. The cost of making aluminum comes all from the power. Power costs are high here, power costs are low there. That's why we buy their electricity. That's why we buy their aluminum.
The logic
what we are doing now, what the White House is doing now, is putting a tax on that. So power costs are high here, and we're making power costs high there as well. Sort of like cutting off your nose to spite your face.
Exactly. Canada, of course, coming out with some retaliatory measures. We know that China also came out with some retaliatory measures, sort of focused on the agricultural segment. But the conversation was that China's response was pretty restrained, that they responded in such a way that wouldn't close the door to talks with President Trump. And we know that Trump has been voicing that he would like to have a phone call with Xi Jinping. But it feels like right now the market is focused on what's going on with Canada, what's going on with Mexico. The fact that the U.S. and China have a tense relationship, that's not really news. But the fact that Trump is going after our neighbors, essentially, and maybe violating the trade deal that he put in place in his first term, that he argued for, the USMCA, is pretty.
He said it was probably the best trade deal ever negotiated, the best trade deal ever signed by a U.S. president. In any case, that's a story that we all know already.
Right.
We are waiting to hear from Justin Trudeau. He has just met with the King of England and the United Kingdom, King Charles, and it'll be interesting to see what he says on the back of that meeting. Of course, Charles met with Volodymyr Zelensky as well before he met with Justin Trudeau, and you're looking live there at pictures in Ottawa. We're going to see this lame duck premier step up to the mic and give us his retaliatory tariffs in just a moment. In terms of what we see in the markets, let's go back again to the boards and just show that we have lost all of the gains in the stock market that we made since the November 5th elections, and we're seeing yields come down.
Yeah.
And this is what Scott Bessent, the Treasury Secretary, said he wants to see.
He is somewhere smiling. I do think it's interesting. I mean, you go back to some of the conversations we were having that Trump cares about the stock market. At a certain point, there will be a Trump put. I don't know if that exists. This administration, in their second generation, seems much more focused on the bond market. And the fact that you have yields just plunging like a stone, maybe that is soothing over whatever the feelings about the stock market might be in the White House. Of course, we won't know know for sure because we're not actually there speaking to the president. You do have to wonder, though, if we continue to see stocks just fall out of bed to the extent that they have. We've erased the Trump bump. We might see more pain in days ahead, whether or not that will outweigh the good news that they're getting from the bond market.
I mean, I'm pretty terrified, frankly, to look at my 401k right now.
Yeah, don't do that.
I was so excited. It was looking so good.
Your financial advisor would tell you not to, but I mean, there's the Trump put, there's also the Fed put. And we are going to hear from Jerome Powell post-Jobs Day on Friday, and you know he's going to have to address this in some way.
Yeah, it's a point I was going to make as well. Not only are we seeing yields come down at the long end, but we're also expecting now more rate cuts from the Federal Reserve. We're going to take a quick break here at the Bloomberg Invest Conference in downtown Manhattan. When we come back, we're going to hear from Soros Fund CEO and CIO Dawn Fitzpatrick. She's going to talk with, among others, our very own Eric Schatzker. This is Bloomberg.
All right, let's go now to Soros Fund CEO and CIO Dawn Fitzpatrick, speaking with Bloomberg's Eric Schatzker.
Good morning, everybody. Dawn, did you ever imagine that we'd be here 6 weeks into the Trump 2.0 era and the Dow is flirting with negative, the S&P 500 is down 2.5%, the NASDAQ is down 6+? Did you?
So I would have thought that the markets would have held up better, but I would also not have thought that we would have had the level of frenetic activity out of Washington. And when we look at the headlines over the past 24 hours, they've been kind of breathtaking in speed and scale.
I'd like to point out, because some of you here may not know, or perhaps you've forgotten, that the Treasury Secretary, Scott Bessent, once had Dawn's job as Chief Investment Officer. He worked at Soros in the 1990s under George, of course, and also under Stan Druckenmiller, and he returned as the CIO in 2011. You arrived in 2017, a couple of years after he left, right?
I arrived about a year after he left.
I bring this up not just to establish a distinguished lineage, but because it serves as a useful reminder that Scott Bessent has to be, right, the most market literate and market savvy Treasury Secretary since at least Bob Rubin and perhaps in American history. Now we have a president whom we know thinks of the stock market as a daily report card, and a Treasury Secretary who's laser focused on macro indicators. Why is that important?
So a couple things. Scott is incredibly smart. He's capable, and I think he is the most market savvy Treasury Secretary we've ever had. I think it matters because when he says something, you should take him literally. So he has said he and Trump care about the level of 10-year treasuries, and I think he will pay very close attention. In a kind of perverse way, right after the election, we had the Trump bump, and as Eric pointed out, we've had something different in the past week or so, and you've seen that 10-year Treasury go from 480 in the middle of January, where they were getting nervous, and if you remember, they kind of backed off some of the tariff timing at that moment in time. Now you have a 10-year Treasury that's down at the 412 level, and I think they should be getting a little nervous. I think the one thing that market participants maybe have underestimated, in the first term, we all said Trump is very SPX sensitive, and that was invariably the truth. I think with Scott, I think their pain tolerance is different, and I think they're more sensitive to a broader set of asset classes, and I think they might believe that ultimately they have more levers to pull when and where they need it. That said, when you think about tariffs, we can all look at a textbook and we can say, and I think the Treasury Secretary said to say, manufacturers will absorb the price pressure, and then you can also argue that it's a one-time price shift. But I think what you can't control is consumer confidence and corporate confidence, and I think that is what is falling off a cliff right now.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
So I would take the other side of that bet because, again, I think ultimately they will bear more pain than I think market participants originally thought, but there will be a limit. And I think they will make deals.
There's a view in the market that Scott's preoccupation with keeping the 10-year yield low foreshadows a coming change in bank regulation. You know, if the administration wants to juice demand for treasuries, it could exempt treasuries from the supplementary leverage ratio, one of the capital penalties that the big U.S. banks have to pay. Do you think they'll go there?
So I definitively think that is going to happen. So when you look at kind of the net issuance of treasuries